weekly broadcast in regards to real estate and all things real estate, including the COVID market and distressed properties. I am joined, as always, by Entrepreneur Man of the Year and voted the #1 COVID realtor in the United States. I had a private vote around the people that I know, David.
Do you lay in bed and dream of things you can vote me?
No, billboards, things I can. It's funny that you say that, and I want to say this to everybody who listens to the rebroadcast. Perfect Blue Studios, which is a company that I've created, did over 1 million downloads in 9 months, and I'm very proud of that. And this is one of the shows that I produce that goes out, and on behalf of Perfect Blue Studios, me as the producer of that, thank you to everybody who listens to this on a rebroadcast and the coaching students who show up each week. Hopefully we can continue to bring extraordinary content for everybody in the real estate world. But yes, I think of billboards, David. I do. I think in billboards, which is very weird. I am joined by David Bartels, owner of Ever Homes and Home Loan Advocates. Take it away, David. Tell them all about it.
Well, good morning, everybody. Well, Everhome is a technology-based real estate company that is really focused on giving sellers the opportunity to leverage technology to sell their house the same way that buyers have been using the internet to buy a house since the invention of Zillow, I guess. And what Home Loan Advocates does is we negotiate short sales. So that'll give you a quick rundown. Those people who want to chat with me, 805-379-3300.
My name is Lee Honish. You cannot see me because apparently iPhone technology does not allow for a video, but I'm here. You can go to leehonish.com, LEEHONISH.com. I am a marketing, media, and content specialist. I specialize in pretty much anything you want to get more of, including bettering your life. Still working out the 30-day hack that hopefully you can apply and change your life dramatically. Again, go to leehonish.com. Give me a call. Actually, send me a text. 858-663-2537. We're going to keep this brief because, as I understand, you are in Cambria still, David?
Well, I made it to Monterey.
Nice.
And I would like to be sitting outside on the ocean, but it's a little chilly here. It's 61 degrees. So I'm in the hotel lobby just relaxing because my wife and I can't both be on the phone at the same time. So that's Perfect. How that works.
So let's just burn through this real quickly. We're just going to run down the latest headlines. Next week, we'll get back to our standard formats of headlines and our focus point. This week in the news, Market Watch is reporting, and just now, let's talk about it. Just so everybody's aware, David, renters in the U.S. cannot be evicted through the end of the year due to the coronavirus, and the CDC is ordering individual states. This coming to us from Market Watch. The Center for Disease Control and Prevention implemented a temporary eviction moratorium through the end of the year, protecting U.S. renters from losing their homes during the COVID pandemic, the Trump administration announced on Tuesday. The CDC's moratorium will apply to all rental units nationwide until December 31st. This is a bit of a difference nationwide, David. Up until now, states like California and New York had it in place, but now we're seeing a national moratorium through the CDC and through the government. Again, let's go through this. This isn't forgiving you of the rents nationwide. This is just putting it off till December, as far as I understand it.
Yeah, so I haven't really read that many headlines this week, but I am familiar with this one. The CDC is basically saying you can't get evicted for COVID-related issues. So if you're not paying rent because you've been directly affected by COVID, they can't evict you until the 31st. There's also a component in there. I want to be careful not to mix up California. California is the end of January. So January 31st, it's actually a month longer. And that component is you can't be you still owe the money. You can't get evicted until January 31st, and then only January 31st if you haven't paid at least 25% of your rent. So in other words, if you are a renter and you don't want to pay your rent, then you're going to be okay until at least the end of the year, and probably longer than that. But you still owe the rent. Both of the laws allow you to sue for rent. You just can't evict. So, I mean, so if you don't pay your rent as a landlord, I could sue you to get a judgment for that past rent, but I don't have the ability to evict you, even if you lose the lawsuit.
There you go. This coming to us from the Wall Street Journal, David. Demand for housing boosts home construction. A surge in home buying demand and limited inventory existing homes is spurring construction to help fill the gap. Home builders attribute the robust sales to low interest rates and shortage of existing homes for sales, and consumers' willingness to move farther from the city centers in exchange for more space. We haven't really talked about this too much. One of the big things that has been going on through the inventory shortage is kind of a boom under new construction. How is it out in the Valley, and how does it look for you as the premier agency out in the Ventura Valley? That was a nice drop.
Well, we're not seeing much activity in terms of home builders, in our market. But just reading the news, and I'm watching, or like everybody else, you can see new home constructions are up. The stock of the home builders is really starting to soar. So if you're a home builder, this is the moment you've been waiting for a really long time. So I don't know. I think it's interesting. Time will tell, once things settle down, exactly what the migration patterns are. I can tell you, in my market, I've been complaining about this for many years now, and that is at 70%, at least 70% of my sellers are leaving the area, and almost all of them are leaving the state.
Yep.
So I've been watching this migration out. There hasn't been many move up buyers. We see some move down buyers who want to leave a bigger house into a smaller house and stay near the kids and grandkids. But the move up buyers, those are move out buyers. They're just leaving the state in most cases, and for a wide variety of places.
Yeah, I would agree.
Every single listing I have right now, which is a lot, is leaving the state.
Yep. My daughter's coming up on going to college in Utah, and when that occurs, I can't find a valid reason not to move myself closer and lower my tax rate and get something, actually get a house for what I get the beach for a shoebox place. It just seems more logical to me. Plus, it puts me in a better proximity to her. For those of you wondering, new single-family home sales rose 13.9% in July from June to a seasonal adjusted annual rate of 901,000, the highest level since 2006. Now, here's why I'm worried about this, David, and I know we don't want to really talk distress, but I know what happened in 2006 to 2007. Are we stable enough, especially with the lack of employment and, generally speaking, the loss of 20% of businesses? Can we sustain these prices going up from your perspective?
Well, apparently, I mean, when you look at it, first of all, everyone's got to be able to, if you're in the real estate business, you got to be able to talk to buyers and sellers about really what's going on. This is nothing like 2006 to 2008. And if you just look at the similarities, 2006 to 2008, you had banks that weren't lending. This is the week of the crash, by the way. This is the anniversary week of the crash. It all started happening about right now. I think Lehman went out of business today or tomorrow, or the next day was the anniversary of them going out of business that led to all the bailouts, that kind of thing. So anyway, I digress. So the big thing is that you had banks that weren't lending. You had people who weren't paying their mortgages, which resulted in a lot of surplus inventory coming on the market and no buyers to absorb them. So you had two things. You couldn't get any money to buy a house, and sellers were not able to make their payments and were, as a result, forced to sell those houses. And you didn't have buyers really coming into the market outside of investors who were looking to pay anything. They were afraid that they were going to catch a falling knife, so everybody really got on the sidelines until the big hedge fund investors showed up with their boatloads of cash and started buying everything up, which ultimately resulted in the turnaround. This time around, you have a shortage of inventory based on sellers not wanting to sell. You've got the cheapest money that you've ever seen, and you've got people who all of a sudden have the possibility of being able to live somewhere else, the different proximity to where they are now because of work, and they're also seeing that their housing needs are different, because they need a little more space, and they can move further from work to be able to get it done. And so what you have is that you have a very high demand and very low inventory, and that is why prices continue to go up. They will stabilize because at the end of the day, there is an affordability problem, but you are not going to see a big crash in prices that come from an imbalance of too much inventory and no buyers. So, the market is going to stay. The market is stable, and it's going to continue probably to inch up, though that should slow down in the fourth quarter until probably the spring. But it looks like the summer selling season is extended until, I don't know, end of October at least. I mean, I've got three. I mean, to give you an idea, I had 3 houses go on the market Thursday, Friday last week. Every single one of them has multiple offers. Every single one of them.
Yep.
So that's what's driving prices up.
Yeah, it is still a basic supply and demand issue of there just aren't enough available properties. And I'm wondering, and I've said this since the crash going into 2010, will those homeowners remember, and will they buckle down? And, if you've got a piece of property, you've got a low interest rate. We've moved a lot more real estate historically over a period of time, and there just isn't the inventory anymore, David. There just isn't.
Well, it'll come back. I mean, I think that's when we'll really see. This is not a normal market condition. This is, so which means, it's temporary, and it'll remain this way until probably there's a vaccine, and they start to see a lifting of the restrictions that are causing many people not to want strangers in their house. And that's really what it boils down to, is people not wanting strangers in their house. And so once the restrictions are lifted, though, there will be a massive surge of inventory. And the question is whether or not there are closet buyers out there that come out of the closet to absorb that extra inventory. That's really what we're waiting to see. The indication is yes, that just like there are a lot of sellers who'd like to sell that are sitting on their hands waiting for this to pass, there are a lot of buyers that are sitting on their hands also waiting for it to pass. And the general consensus is that there will still be as many or more buyers for sellers, and that will continue the flat to up trend that we're seeing in housing prices.
Moving forward, again from the Wall Street Journal reporting, mortgage refinancing boom even as coronavirus hits economy. The mortgage market recorded its best quarter in years this spring, a reflection of how the housing market is booming in 2020, even as the economy stumbles. Black Knight's reporting lenders have issued 1.1 trillion in home loans between April and June.
Yeah, I heard that number yesterday.
And well, let's just talk about that right there, right? So I can understand why mortgage people aren't concerned about making new home loans or even trying to make those loans based on shaky businesses and the economy in general. But when you've got this is my problem with real estate, David. I feel like I'm about to have a John Oliver moment. My problem with real estate is whenever real estate agents, mortgage people, escrow people, title people reach a boom period, they have no vision for the future, right? The banks do the same thing. They overhire processors. They double down on the production. I would assume if I owned a mortgage company, I would hire as many processors, underwriters, and brokers as I can get my hands on to try to be a part of this boom instead of slow and steady winning the race. Everybody just sort of doubles down to feed on the market. And that's ultimately what creates crashes in those businesses on the back end. It's kind of a common thing, especially with, I've seen it with real estate offices when I've consulted and revamped, where they hire a lot of people. I'm going into the mortgage business. I've hired an attorney. I've done this. I've put an escrow company in. I bought this beautiful office, and now it's all changed. Instead of, as a person who's created a new brokerage, how do you keep a slow, steady rate and still manage to grow exponentially without spiking it and crashing it, which is very common in the real estate industry?
Well, I think we're seeing what the banks are doing. They're raising prices in order to slow down demand. So when their pipeline gets full, they raise rates, and then the influx of new transactions slows, and then they catch their breath, and then if they find that they have excess capacity, then they lower the rate again. And so what we've been watching them do is basically adjust the rates up or down in order to increase or decrease deal flow as is needed at the moment.
There you go. Quickly talk about Everhome right here. Insert ad now.
Well, it's not really an ad, but we're doing some really exciting things. Is that, in terms of, we created a technology that basically allows sellers to list their home themselves right from their phone in about 20 minutes. And, we invented a new program, a new category called Listed with Owner. And Listed with Owner basically will allow a seller to input their information into the multiple listing service from their phone. We charge $450 up front. That covers our administrative costs of getting them into the multiple listing service, and they handle the showings, themselves. So they get the flexibility, control, and cost savings of listing it with an agent for 5 or 6%. And the big difference here, it's not an MLS entry only. The big difference here is that when they get an offer, that offer comes to us, and one of our experienced agents jumps in to provide them with full service representation for the critical elements of negotiation and paperwork and contingency removal, escrow and title, those kind of things that they say that they want assistance with. And then we just charge another $2,500 at the close of escrow, regardless of the price of the house. And so that has been a massive boon for our business. And instead of a seller having having two choices. One is for sale by owner, where they're completely unrepresented and don't get the exposure of the MLS, versus fully represented, where they get the MLS and an agent taking care of everything for more money than they think they ought to have to pay. They've now got this third option, which is called listed with owner. Now, we're also providing full service listings and full service buyer agencies, and through our technology, generating a massive number of leads. We do have an agent shortage at our place. We're generating about 50 appointments a week for our sales team of 4. And we desperately need agents in the LA and Ventura area. And we're also building a list of affiliate agents that we can do referrals and co-brokerage relationships with clients around the state of California. So for those people who are interested in having that conversation, David at everhome.io, David at everhome.io, or you can call me 805-379-3300.
Simple as that. Our marquee story of the week, and we're going to break this down inch by inch to make you all experts on the topic, because this story broke last week, and it's kind of important. The Fed has a new approach to inflation, which means for your savings, credit card debt, and your mortgage rate. The Federal Reserve is shaking this coming to us from Market Watch. The Federal Reserve is shaking things up, which is both good and bad news for consumers. Shocker. The Fed made some big changes to its policy in years following an extended review. The central bank has revised its approach to inflation and the labor market in a move that could usher an extended period of low interest rates. So your question is, what did the Fed change? So let's talk about this, and maybe you can break it down so everybody understands, David. The Fed is now officially less concerned about high inflation. What does that mean in English?
Well, homeowners are worried. They call inflation appreciation. That's why housing values are going up, because it's basically a result of inflation. And as I understand it, they've been trying to moderate growth. The Fed wants a little of inflation, but not too much. So it's this fine line between what's working. And I think they've always had a target rate in the 2 to 3% range. That's what they'd like to see. And it also helps the economy grow, especially things like housing. Like I said, we call it appreciation, but most appreciation in housing is driven through inflation. So what you have is a situation where they're going to be really less concerned with inflation and really more concerned with things like savings rates. They're concerned with consumer spending. They're looking at other metrics, and they want to encourage GDP growth. And GDP growth really is based on how much money are people spending in order to stimulate the economy. So I think that I think it's good overall. I think we had already anticipated that interest rates were going to be in this range for a long time to come. I think that bodes well for housing and other industries that are interest rate reliant, like general consumer spending and automobiles. So we'll see how that goes. I think it's probably the right policy. The stock market seems to be doing just fine. If you discount the last couple of days, 3 days, it's been kind of interesting to watch. I don't even know what it's doing yet today, but yeah, I think that we're going to see more steady growth and a lot less automatic adjustments based on inflation. They're going to focus on other patterns like spending.
You are 100% correct. They've been averaging closer to 3%, but moving forward, the central bank will target inflation that averages 2% over time. That follows a stretch with low inflation. The Fed might allow inflation to run above 2% for a period of time. The biggest change in this particular topic, in the past, the Fed officials' view was that a strong labor market could cause inflation to jump. As a result, the central bank would move to raise rates even higher. They are going to be now less concerned with the labor market. I can't imagine why, David. Why suddenly are they not concerned with the labor market?
Well, I mean, because it's all tied in. If you just get to the
Right,
common denominator, it really comes down to spending, right?
right.
So, so that's really what their focus is on, is spending. And
Spending.
low interest rates that encourage businesses to borrow and to expand, and which includes hiring more people. This is why they don't, if you were to look at all the different factors, it really just comes down to spending. And so you want to see the economy growing, and GDP is really the best way to do that. And if you take care of that, that solves a lot of the other problems. It solves the inflation problem. It solves the unemployment issues. It encourages people to go back and work. They just want the economy to expand, and
Yep.
low interest rates do that better than anything else, any other levers they could push or pull.
Which brings us to our next section, which is exactly what they're after. Americans will save on their credit card interest rates because of the Fed's new policy. The good news for Americans with credit cards is that your annual percentage rate on your card should go down or remain low for the foreseeable future. Quote, card APRs are still high, but they're actually the lowest they've been in years, largely thanks to the Fed, said Matt Schultz, chief credit analyst for LendingTree. Their latest announcement means the rates are likely to stay at low levels for some time. So they're trying to stimulate credit, right? Expand the dollar again and continue the growth, as my understanding of this, David.
That's all that's going on. They just want to continue. They want the economy to expand, and low interest rates are likely to do that. Now, I don't know what low interest rates on credit cards mean. Is that 14%?
Yeah, right.
I don't know. It's still a lot. When I look at debt, credit cards are what I want to pay off first, um, but the typical consumer, if interest rates are lower, they might be incented to go out to dinner more, to travel more, to buy more retail goods like clothes or furniture, so more groceries, those kinds of things. So that's all good. That's all trickle down economy, basically, where every time you buy a can of beans, there's a very long supply chain that benefits from that. And that, at the end of the day, that's really what they're trying to stimulate.
And finally, mortgage rates could actually rise even if the Feds keep the rate low. Long-term interest rates will be much less affected by the policy change. Mortgage rates don't respond directly to move on the Fed's part because the Fed only controls short-term interest rates. Instead, the rates on mortgages ebb and flow in response to movement in the long-term bond market, particularly the yield on the 10-year Treasury note. Therefore,
Right.
mortgage rates are more subject to the whims of bond investors. We've talked about this previously. When people hear that the Feds drop their lending rates, somehow it's magically going to have some kind of impact on the real estate market, and instead it's part of the bond market. Go ahead and expand on that a little bit.
Well, yeah, the Fed rate has nothing to do with the mortgage rate, but what it has to, so if you look at, you have the bond market and you have the stock market. And when you think about where people want to invest their money, they're, some people are looking to be people who are being a little more risky and a little more aggressive in their investment. They have a tendency to be in the stock market. And people who are a little more conservative and risk averse, they have a tendency to be in the bond market. And when people flee the stock market because of volatility, now is a good time. The market has really, been in an adjustment the last few days. There are a lot of people that take take cash out of the stock market and they move it into the bond market, which like the stock market moves with supply and demand. So when demand is high, interest rates go down, and when demand is low, interest rates go up. And the same, but on the stock market, when the demand is high, stock prices go up, and when demand is low, stock prices go down. And so, so basically people are trying to decide where do they want their money. Do they want it parked on the sideline at 0%, or do they want the yield that the bond market represents? And so most mortgages are pegged to the 10-year bond market. And so that's really what you want to see. Now, out of this $1.1 trillion that the mortgage companies did in the quarter, a lot of that has been artificially high. They could have offered a lower rates, but they didn't, because they were also dealing with their own supply and demand issue. Their bandwidth wasn't big enough in order to handle all of the demand. So, like I said earlier, they raised their prices, and so that moderated the influx. And even with that, they ended up doing what sounds like a record volume of transactions. So I think that they generally go together. There's a general interest, but it's not pegged one over the other. But I think generally that what that Fed rate does, though, is that's what the banks are able to borrow at. And so,
Yes.
generally speaking, that's their cost of the money, and then they compare that to the bonds. So they're taking the 10-year bonds and they're lending that out in 30-year mortgages. So it's probably going to stay the same. There's no indication that mortgage rates are going to go up, much. They're going to, maybe an eighth or a quarter here up or down based on, many factors, mostly supply and demand. But it looks like through the end of 2021, mortgage rates are going to be really pretty steady, which is probably going to result in a robust housing market, especially when more inventory becomes available as a result of COVID restrictions lifting.
Absolutely. And with all of that said, they end the article off by saying the Fed can take certain actions that would keep mortgage rates down. This quote from the chief economist of LendingTree. The Fed being more accommodative might mean that they are purchasing more mortgage-backed securities and treasuries, which could counter the inflationary effects of the longer rates for the things like mortgages. So it looks like they're going to. One of the things that's working for our economy is housing, right? It's still a secure investment long-term, David.
Yeah, and it's a big transaction too. And so with, and it's a lagging indicator. So they're being very careful not to have housing be a strain on the economy. They don't want it to be weight. So they're propping housing up by keeping interest rates, low, and it looks like it's going to expand. I mean, it looks like we're going to do 5.8 million houses this year, transactions. That's more than last year. So, that is a surprise to a lot of people, including me, because we're still talking about an inventory shortage. And there are some markets that have had some, that are having their challenges in terms of price appreciation. But there are places like New York City and Miami and downtown LA, where there are just, where people, they're big urban centers that the people have fled those areas for the suburbs. So they're no longer constrained by work.
There you go. David, tell everybody about Everhome.
Well, Everhome is a technology-based real estate company that services buyers and sellers, in particular sellers who want to leverage technology to sell their house with the assistance of full service professional representation. If you want to learn more about Everhome or you're interested in joining our team in California, 805-379-3300. And you can email me at david@everhome.io.
With all of that said, if you need assistance with marketing, media, content, consultation, and build outs, go to leehonish.com, leehonish.com, or send me a call or a text at 858-663-2537. We thank you all for being on the broadcast this week. You can hit the button.